In technical analysis, divergence happens when an asset price and a momentum indicator move in opposite directions. Let's see what this means. Divergence is a signal that the current trend might be losing its steam or strength. It occurs when the price makes a new high or low, but the indicator fails to follow that same path. Traders watch for these patterns to spot potential reversals before they become obvious in the price action. While confirmation shows a healthy trend, divergence acts as a warning light that the momentum behind the price move is fading. In this bearish example, the price climbs higher, but the relative strength index indicator drops, signaling the rally may be exhausted. Never rely on a single indicator. Use divergence alongside other tools to build a more complete picture of the market. Thanks for watching. Understanding market mechanics helps you make better decisions. Remember, this is educational content, not financial advice.